Shift Technologies is a company growing at a massive clip. These guys just came out and reported Q4 revenue growth of 164% year over year. In this video, I'm going to cover exactly what management reported, what management said during the conference call, exactly what my price targets are for the company, and what I'm doing with the stock. Now, if you don't know what Shift is, have no fear. I'm going to put a link. It'll be the first link in the description. That will take you to my full Shift analysis where I go in depth into what their business model is and what they do. This is going to focus solely on earnings, my price targets, and what I'm doing. So without further ado, let's get into it. Q4 management expectations for Shift was around $72 to $75 million in revenue. And that originally was expected to be around 163 to 174% revenue growth year over year. Now, management came out and said they reported revenue of around $73.4 million, which is right in line of their expectations, very healthy. That's 168% revenue growth year over year, or 24% revenue growth quarter over quarter. Now this is big, guys. Generally there is a kind of a big headwind when it comes to Shift, or just the general kind of used car market. From Q3 to Q4, revenues tend to either kind of decline a little bit, or there isn't as much demand in Q4, generally speaking, from the entire year. Now, Shift, at least for this quarter, they managed to overcome that headwind and actually grew revenues by 24%. This is the first time in this company's history that they grew revenues in Q4. Normally it would take a slight dip from Q3 and start taking off again back in the beginning of the new year. So given the fact that they reported 24% quarter over quarter growth is absolutely huge, guys. So when it comes to kind of vehicles delivered, this was my original estimate. In Q3, Shift reported revenues of around $60 million, and they said they sold around 4,050 cars. So just doing the math, that comes out to around $14,800 per kind of car, or revenue per vehicle. So by kind of management's expectations when it came to revenue, I had an expectation of vehicles delivered of around 5,066. Now, here today, they came out and reported units delivered of around 4,666, which is a little bit less than kind of my expectation here, around that kind of like 300 figure, 300 units less. Now, the reason they were able to kind of still hit their revenue targets is because the revenue per vehicle actually increased a little bit by a couple $1,000s. It was at around 14,800. It increased around a few $100, and they managed to hit that revenue number of around $73 million. So, nothing too kind of surprising there. We'll get into future guidance in a second here, and it's very exciting what they expect to happen over Q1 of 2021 and over the year 2021. So gross profit per vehicle. Now, this is something that I really emphasized when it came to Shift, as it is really one of the key determining factors when it comes to their profitability, not just now, but also in the future. And I'm going to be honest with you guys, gross profit per vehicle did take a big hit in Q4. Coming in at around $514. Now, I'm not sure if, in Q3, they reported kind of gross profit per vehicle of around $1,265. And, given the fact that this is now at $514, that is a big hit. But I'm going to explain this to you guys here today. This didn't just happen out of the blue. Now, when Shift receives an original car, they have to recondition the car, tidy it up a bit, take pictures, and really kind of put it up to the standards that they want it to be. Now this, costs a certain amount of money. Now they do this with two ways. Either they recondition the car in-house with their own facilities, with their own workers rather, or they hire a third-party supplier, which is obviously much more expensive. Now during Q4, Shift experienced unprecedented demand. This is what they're saying. And they essentially did a lot of third-party reconditioning. And this is why that gross profit per unit took a decline, at least in Q4. Now they expect this number to bounce back pretty hard when it comes into the new year, as they now have only around 10-15% of their reconditioning happening from third-party suppliers, and they now have around like that 80-85% range coming from actually their own workers, which is very good when it comes to gross margin, and they expect this number to jump to around that $1,200 to $1,350 range not in the back half of this year, but rather in Q1 of 2021. So this is very like kind of short-term noise when it comes to Shift, and is not something we should be worried about. This is very good, as it doesn't really affect Shift in the long term, but might kind of put a bit of downward pressure on the stock possibly in the short term, which is what we like as investors, having an opportunity to buy low when things are actually going well, right? So next we can look here. This is something that I mentioned, Carvana. This is a company that is a very established, again, e-commerce used car giant, and they make gross profit per unit of around $4,000. And this is kind of what gives Shift that runway to get to much more profitability going forwards into the future. Now, again, they're expecting around $1,200 to $1,350 of gross profit per unit in Q1. In 2021, they expect this number to kind of average out at around $1,600. So that is a little bit higher than it was last year, sitting around that kind of like that 13, or what do we have here? The $1,265 range in Q3. They expect this to jump to around $1,600, averaged out over 2021, which is very beneficial. And in the long term, they expect this number to jump to $2,500. Very big, guys. $2,500 per car. When we go look at my price targets, this is going to play big when it comes to gross margin and profitability, and you'll see why I'm so excited about this business. And by the way, guys, if you appreciate this information, very kind of neutral when it comes to perspective, just giving out the data, make sure to subscribe to see more content just like this. Now, let's keep going here. Advertising expenses. Now, this is one of the things that I highlighted as advertising is one of the things that they're taking more seriously, spending more money on, and it's one of the things that is really stopping them from becoming a profitable company, at least for the short term here. Now, as expected, the kind of like the marketing costs came in at around $11 million. And given that revenue was $73 million, that really hurt the bottom line. They lost around $28.9 million in total in Q4. So that played big when it comes to that loss. That was expected. Now, what is their rebuttal to this? They want long-term growth and long-term value. And as a new company, they want to advertise. They want to get their name out, and they want more people to know what Shift is and what Shift does. So obviously, advertising expenses could be high now, but it really helps with that brand awareness and that long-term value. They really emphasize that. In the long run, they expect to get to profitability. Management expects the 2023 range is where they want to flip that switch from kind of being an unprofitable company to going to profitability, which is absolutely huge. If they, once that moment happens where they flip from an unprofitable company to a profitable company, expect big things to come to Shift. So, this kind of highlights what their Q3 expenses were. Obviously in Q4 this increased pretty substantially, and they experienced a loss of $28.9 million compared to a loss of $23.3 million in Q3. So that actually grew, which isn't obviously the best thing, but again, it's just short-term noise related to costs with obviously that reconditioning, the marketing expenses, and things along those lines. A lot of those will go away in the coming kind of quarters here. So when it comes to profitability, analysts were pretty in line with their their expectations. When we look at just their net income, we'll see a loss of just a few $1,000,000. This is just an accounting trick because of kind of like the change in value in some of their different products. Really, they reported a loss of $28.9 million, which comes out to around EPS of -42, -43 cents. So, again, analysts are pretty online with this. They are not a profitable company. They probably won't be for the next couple years. That's fine. They're focusing on growth, and it totally makes sense to spend money now and invest in the future. So when we look at 2021 guidance, this is where we kind of really get some exciting stuff. They expect revenue in 2021 to hit $450 million. Now, this is huge, guys. I'm not sure if I have analyst expectations here. Originally, analysts expected $392 million in revenue for the year 2021. Shift just came out and said they're reporting they will most likely do at least $450 million in revenue for 2021. A beat, or rather not beat, but an increase of around that 15% mark when it comes to their revenue. Absolutely huge. They were already growing by 100%. This kind of increases that growth from 100% to around 115% for 2021. Huge growth that this company is experiencing, and that kind of puts it into perspective as to why they're losing money, right? And then when we look at kind of profitability for the next quarter, Analysts expected the decline, or the loss, to kind of decrease. Management expects it to actually increase, which isn't too good. They're expecting a loss of around $33 to $33.5 million in a negative EBITDA, which is not too kind of good when it comes to the stock. Again, just short-term noise though, because in the next quarter they're expecting revenue of around $90 to $95 million. Huge. Again, a giant beat. Analysts were expecting revenues of around $72 million, right? And Shift just came out and reported, or rather is expecting revenue of $90 to $95 million. And keep in mind, this is a 3x, 200% growth year over year when we compare Q1 of 2020 to Q1 of 2021. And it really plays to that growth that they're expecting. Huge growth. It's just the profitability that's keeping this company from absolutely exploding when it comes to stock price. So when we can look at the conference call here, I listened to the whole thing. I really recommend you check out the description. I'll have a link there to where you can actually listen to the conference call. I'll give you some highlights. They talked about profitability and how they're really investing into the future, and how marketing is really putting a lot of short-term pressure on their profitability. Same goes for their reconditioning. They really emphasized the reconditioning point. I think this was one of the main kind of topics that they talked about. Again, they're experiencing a ton of demand. And they honestly, what they said from their words, they're experiencing so much demand that they don't have enough capacity for reconditioning to meet that demand. Now, obviously, this was in Q4. They ramped up their reconditioning capacity in January and February. That is now sitting right around, I believe it's 500 cars per week that they can recondition, or 6,000 units per quarter. Keep in mind, in Q4, they delivered 4,666 vehicles. They now have the capacity to recondition 6,000 per quarter. So obviously a big increase when it comes to that. And that's one of the things that will allow them to increase their revenue so substantially over the coming quarters. Kind of that ability to scale so much quicker and so easily. So, that's kind of what they talked about. They said 2023 is where they're targeting profitability. Again, reconditioning and pricing is where they'll be able to increase, or that gross profit per vehicle. They said $2,500 of gross profit per vehicle is their goal. They'll get that by raising prices periodically and by kind of reducing expenses when it comes to reconditioning. A lot of their growth in the short term here is going to come from their original markets where they're in now, and they're planning to expand into a variety of different markets like Texas and I believe Seattle in the next year here, and they're expecting that to be a big kind of proponent of growth going forwards. Again, this is a company only operating in around 6 to 7 states. California is their biggest market. The opportunity in the US alone is absolutely massive, and I'm really excited for them going forwards. Android app, they did not comment on this. If you don't know, Shift doesn't currently have an Android app. They only have one on iOS and obviously online. This isn't the biggest of deals, but it would be nice to see Shift actually download their Android app. This is something that we want to see. And I'm not sure if I mentioned this, units sold for Q4 were around 4,666 units. So, that's generally where we had with the conference call. They also mentioned $242 million in cash. Very great balance sheet when it comes to a company of their size. They're at around a $700 million market cap. And to have literally 30 to 40% of your company in just cash, just makes absolutely no sense in my opinion, and really shows how underappreciated Shift is relative to the other market. So obviously before kind of this earnings call came out and the report came out, this was my bottom line, what to watch. Expectations are low, and advertising spend and profitability, or rather profitability, will be heavily reliant on advertising spend. Now, in my opinion, expectations were low. I mean, the stock price is up around 10% after hours now, which kind of shows to how investors kind of like these earnings. And generally, advertising spend was higher than expected. Again, this isn't leading to a sell-off in the stock because of that kind of huge upset when it comes to 2021 guidance. This is a company growing at such a huge rate. And, given that investors are almost turning a blind eye to their negative kind of earnings per share, which is, in my opinion, as it should be. They're a growing company, and they'll be fine spending money on advertising if it does end up resulting in huge revenue growth going forward. So here we can have a look at my updated price targets for Shift, and this is really exciting, guys, and really shows the potential that this company has over the next kind of few quarters and over the next few years here. So current share price around $8.32. This is where it's trading at after hours right now. It seems to have stabilized at this level, which gives us not a current market cap of $1 billion. Currently, the company has 83 or 84 million shares outstanding. I'm including dilution of right around 45 to 50% over the next 5 years here. Keep in mind they're an unprofitable company and they will most likely have to raise money in some form. Now, honestly, I think 120 could be a little kind of on the very conservative side. We can go 110. I think that's kind of fine when it comes to Shift. You really want to price in dilution when it comes to companies like these, as they are losing money pretty substantially. And, if you can make money with that giant dilution, that's great. So, given that, and not analyst expectations, but Shift's expectations of $450 million in revenue in 2021, we can actually project 5 years out. Now, I'm expecting revenue growth of 73% over the next 5 years here. This is how I got it. In 2021, revenue is expected to grow 125% to $450 million. And as the numbers grow, I'm expecting the acceleration of the revenue growth to decline pretty substantially. And I have this declining by a pretty substantial amount, by around 20% every single year. I think this is very kind of fair and is on the conservative side. I'd like to be conservative with my investments. So now, at a $4 billion revenue run rate at 2025, we can play around with this number. Now, assuming that they reach their goal of $2,500 per car, which in my opinion, again, conservative. That's their midterm goal. Over the long run, over the next 5 years here, I think this can get closer to $3,000, but we'll look at that in a second. That's gross margin of around 16%. Now, I have a net income margin from that of around 5%, meaning that, for every $100 in cars they sell, they get around $16, and then after advertising expenses, after paying employees, after, paying a variety of different expenses, that drops down to 5%, and then that goes down to the bottom line. So that's why I have a kind of net income in terms of next year at around 22 million and net income by 2025 of around 200 million. Now, are they going to report positive income here for the next 2 years? Probably not. But this just shows where kind of earnings can be over the next couple years here. Again, I think 2024, 2025 is where they really start showing this profitability. Now, we can apply a price to earnings ratio of 30, which, could be considered conservative, could be considered bullish. I really think this is very much on the conservative side when it comes to Shift due to their massive growth. We'll play around with this in a second here. Shares outstanding, we know that. That gives us a price target of around $55 per share. When we multiply that PE ratio by their net income, again, a $6 billion company, which translates to $55 per share, or upside of around 561%, or a compounded annualized growth rate of around 45 to 46% over the next 5 years here. Absolutely huge. And this is the base case, guys. Let's kind of play around with these numbers a little more. We're being very conservative with our growth here. I'm expecting a revenue decline in terms of acceleration of 20% over the next kind of 5 years here. Let's increase this by a little bit, right? Let's go to 75. Let's expect gross margin to increase a little bit. What if they get on kind of like that upper half of those $2,000 range? What if we have gross margin of around 18% and that translates to a net income, or let's go a little higher. Gross margin of 19%, that gives us net income of around 7%. Boom, $80 per share. And what if at that point, Shift is growing so significantly that they demand a higher price to earnings ratio of maybe 35, or not 455, 35. That's where you get to that 10x range. Is this going to happen? Who knows? It very well could. We have to prepare for every single possibility, guys. In my opinion, these numbers here that I'm laying out right now are very realistic and could very well happen, or I think I have this at around 16%. In my opinion, Shift is a company growing at such a substantial clip that they don't even have to hit a lot of these kind of like upper numbers for their stock to absolutely skyrocket. I mean, even with like these base case scenarios, we have upside of around 560%, which is why this is such an exciting company. Now, again, I personally have around 4.5% of my portfolio in Shift. After this earnings report, I want to add to my position, and I would be fine making this a 10% weighting in my portfolio Based on what I'm seeing here, the minimal risk, the potential upside, which is huge, and I really look forward to this company's future. They were so positive on their earnings call. They just absolutely killed it. Just a substantial improvement since their last earnings call. They were a newly public company back then. Now they know what's up. I really like this company. If you do too, make sure to smash that like button. Let me know what you think in the comments down below. Thanks so much for watching, and have a great day.